Hey guys, my name is Eric Wilson, and today I'm going to be talking about the 4 different risk profiles in private equity real estate. Private equity real estate is the purchase, development, and management of real estate properties, usually through an investment vehicle such as a private equity fund or a syndication. So before I talk about the different risk profiles, I'll just briefly explain the differences between a private equity fund and syndication. This is usually one of the first things that I tell investors to consider when they're thinking about getting into private real estate. Would you rather invest in one single asset, which would be a private equity syndication, or would you like to invest into a pool of assets, maybe 5, 10 different properties? That'd be a private equity fund. I like to use the analogy of it's like picking and choosing a stock to invest into or picking and choosing mutual funds to invest into. So if you have 100,000, 250,000, would you rather put that all into one stock, or would you rather put that into some sort of a mutual fund where you can get exposure to a certain sector, or what have you? That's a fundamental strategy decision that investors need to make when they're investing into private equity real estate. You can do both too, depending on how much of your portfolio you want to allocate towards private equity real estate. You can have some investments that are in funds, you can have some investments that are in syndications. Picking the right balance, again, that's up to you to decide. Same thing as, it's up to you to decide how much of your portfolio should be in mutual funds versus stocks and bonds. It's pretty simple. It's the similarities are right there in front of us. I try to make as many analogies as possible because it resonates with a lot of people, but that's how I like to talk to people about it right from the start. Once you've kind of figured out what your strategy is over the next couple of years, you picked your investment vehicles of loosely what you think you would like to do, understanding the different risk profiles that are available to you is probably the next, if not the most important piece of the investment strategy to figure out. Now, when it comes to real estate, risk profiles are defined into 4 different categories. You've got core, core plus, value add, and then opportunistic. And with each level of different risk, there should be a commensurate amount of return that you would expect for that investment. So core being the least risky, and then opportunistic being the highest risk, you would expect lower returns with core investments, and you would expect higher returns with opportunistic investments. Now, let's get into the definitions and a few examples. So a core investment would be, this is your cash producing stable asset. So think about a multifamily property that was just recently developed. It was fully leased up in the last 6 months, year, and now it's fully occupied, fully stable, fully leased, fully producing income. That's a core investment. You invest into a property at that stage, it's gonna produce income, it's stable. The amount of risk in a property like that is minimal. People wanna live there. It's clean, it's new. It'd be rare to see a brand new asset like that once it's fully leased up, then go the other way and then no one's living there. It does happen. We go into a recession, people downgrade their investments, downgrade their living situations. These types of things can happen, but generally speaking, a core investment is your lowest risk profile investment for real estate. It's going to produce income. If that's your goal, to generate income off of rental income, a core investment would be for you. A core plus investment is a step above a core investment. So maybe a property that's been around for a few years and the rents are not quite up to market rate yet. So there wasn't those adjustments made on an annual basis. So there's an opportunity to buy this property and maybe adjust the rates a little bit. Not massively, but just enough to get it up to market rate. That would be a core plus investment because there's a little bit of upside potential, but generally speaking, this is a cash flowing property. It's producing income. It's already producing income. You're not stepping into a property that you're saying, okay, I'm gonna shut everything down. Let's do a bunch of rehabs. No, this is just a core plus. There's an opportunity for upside, but it's generally producing income. Another example would be if it's, it maybe has a few vacant units. Not a significant amount of vacancies, but again, there's an opportunity to buy this property and increase the income potential by filling up those few vacant units. That's a core plus investment. Now, a value add investment is a whole different ballgame. Now we're getting into serious renovation projects. We're getting into a significant amount of lease up in these properties. So a property that has a lot of vacancy, There's a lot of opportunity for growth by putting tenants into those buildings, but first there's probably a reason why it's vacant, right? Like these properties have challenges. They're challenges, they're opportunities, they're things that need to be fixed in order to get this property up to its potential. That's a value add investment. Again, there might not be as much income right at the beginning. You might even have to, block off some of the property or all of the property and say, we need to completely change out all of our tenant base. We need to rehab this property. We'll be back up and running in 6, 8, a year from now. But then once we are, it's going to be producing more income, and we've forced appreciation into this property from the point that we bought it. That's a value add investment. Again, a little bit of higher risk, but a higher level of return with that investment. And then you have opportunistic investments. Now, opportunistic investments are your highest degree risk. They're also your highest degree of return potential with these investments. Think land development. Think massive repositioning deals, redevelopment, distressed properties that are coming out of bankruptcy, the foreclosure process. Properties that have serious real challenges to them would be opportunistic. One of the things about these properties is that once you do get on the other side of them, once you develop a brand new property, there is massive growth potential. People make a ton of money in development for a reason. You're building something that wasn't there before. So there's a lot of baked in appreciation by doing that sort of development. Development is something that my company does a lot of, but we also employ a few strategies to mitigate some of that risk and also keep our investors in for a little bit more of the cash flow. So we do what's called build to core in a lot of cases. Build to core would be, we have investors that will come in at land development with us. We'll build the property, and then at the end of the property, our investors stay in, we lease up the units, and then we refinance out of our construction debt into a long-term permanent financing solution. And our investors have stayed in the property all the way through, so they haven't captured the growth yet. They have on paper, but they haven't sold the property. They haven't received back their initial investment yet. Their investment is still in the property in the form of equity, and they're staying in the property, receiving cash flow on a regular basis moving forward. So that's kind of a blend across strategies, and those are out there. You can invest in build to core funds. You can invest in build to core syndications. It's not necessarily cut and dry. You invest in a core, you invest in core plus, you invest in value add, you invest in opportunistic. You can have some creative products that are out there, but that's those are out there for you to find. Unfortunately, in the private real estate arena, there isn't a public marketplace where you can go and say, okay, I want to filter by these types of investments. The ones that are out there, there are different tech platforms that offer some solutions similar, but again, this is very much a relationship-driven business when it comes to private real estate. You want to get to know the managers that you're investing with. You're trusting them a lot, whether it's in a syndication or in a private equity fund. You're trusting them with your capital, and a lot of the success of a real estate deal hinges on the manager that you're trusting your capital with. It's very important in a syndication. I would say it's more so important in a fund structure, because you're trusting that manager to spread out your capital onto several different deals. You're deferring a lot of the due diligence that you would do on one property onto all the properties with that manager. So again, I'm not downplaying the amount of due diligence that you need to do with a syndication. You can actually do a lot more as an individual investor on one property. It'd be a lot more time consuming to go through a fund with a fund manager and sit through each property that you're investing into and do the level of due diligence that you would do on one property. You're paying the fund manager to do a lot of that due diligence for you. There are pros and cons to both, just like there are pros and cons to the different risk profiles and investment options that you have available. So these are the different risk profiles that you can invest in with real estate: core, core plus, value add, and opportunistic. Not to be confused with asset class. Asset class would be a Class A property, a Class B property, Class C, Class D. People can often confuse risk profile with asset class. People confuse asset class with property type. Real estate uses a lot of different terminology, and we can go into all of those topics on this channel. I just wanted to make that distinction that risk profile is separate from asset class. I hope you guys enjoyed this video. Please like and subscribe so that I can keep producing these videos. I'm enjoying it. I hope you guys are too. And we'll see you in the next video.